You click this video because you are 52 years old, or perhaps your parents are 52, and you have zero. Not zero as in being slightly short on cash, but an absolute, mathematical zero on your investment account. A guy on TikTok tells you to just buy an index fund, and in 30 years, the magic of compound interest will make you rich. That guy's expected value is equivalent to a survivorship bias error, because 52 plus 30 is 82. At that age, your ability to enjoy a 3% dividend yield will be strictly limited by the cost of pharmaceuticals and the inflation of elder care services. The standard investment model is dead for you. It relies on the variable n, where n is time, and it must approach infinity. You do not have infinity. You have a window of 10 to 12 years before your human capital begins to decay at a rate of 7% per year. Hi, I am Kyle. I am your Mirror Financial Forensic Auditor. Today, we are destroying dividend fairy tales. We will not use adjectives like successful or happy. We will use derivatives, tax arbitrage, and the Sharpe ratio. If you start now following the classic advice, you will lose with a probability of 99%. But if we transform your portfolio into a system of premium harvesting and tax optimization, we can reach a yield that outpaces inflation by 300%. Let us look at our Kyle. He is 52. He is a Henry, a high earner, not rich yet. He earns $8,000 a month, but his net worth is zero. Where does the money go? Let us run the audit. 32% goes to taxes if he is in the wrong jurisdiction. 25% covers debt servicing, including a mortgage, a car, and credit cards with an annual percentage rate of 18%. 15% is swallowed by lifestyle creep, or trying to look like he started investing at 22. Kyle tries to invest the leftovers, and this is a first-order error. Your return from the Standard & Poor's 500 is 8 to 10% per year before taxes, but your car loan at 12% annual percentage rate is a guaranteed negative alpha. You cannot build a dividend plan while you have liabilities with a cost of servicing higher than the risk-free rate. The first step of our plan is deleveraging, which means we do not buy Apple shares, but instead, we buy back your own debt. Closing a loan at 18% is the equivalent of buying an asset with a guaranteed 18% annual yield with zero market risk. No dividend aristocrat will give you that spread. If we reduce the tax burden by 12% through proper structuring and liquidate the debt, we free up 40% of the cash flow. For Kyle, that is $3,200 a month. This is our fuel for the engine. Now, let us talk about the gurus and their dividends. They say buy stocks with a 4% yield. Let us apply forensic logic. A dividend is not a gift from the company. It is a forced liquidation of part of your ownership. On the ex-dividend date, the stock price drops by the amount of the payout, representing pure accounting neutrality. But there is a catch, a tax catch, where you pay tax immediately, between 15 and 30% depending on your structure. You lose the compound interest on the tax amount, a phenomenon we call tax drag. Over 13 years, this drag will eat about 22% of your potential capital. We do not need dividends in the classic sense during the accumulation phase. We need total return with deferred tax liability. We will use a yield enhancement strategy through option selling. Imagine that instead of waiting for 3% from Coca-Cola, we force the market to pay us a risk premium. We will sell cash-secured puts on stocks we want to buy, and covered calls on stocks we already own. This allows us to raise the synthetic yield from 3% to 12 or 15% per year. This is not magic. It is volatility exploitation. While the gurus pray for the quarterly report, we harvest time value known as theta, like a tax inspector collects duties. Back to our Kyle at 52, the gurus tell him to just buy dividend stocks in your regular brokerage account. That is financial euthanasia, because if you are in a high tax bracket, every dollar of dividends is taxed at a rate of 15 to 37% before you even think about reinvesting. In investment banking, we call this tax leakage. Over 10 years, this leakage reduces your expected final capital by 28%. We need structural armor. If you are in the United States, it is a Roth IRA or a 401k. If you are elsewhere, it is using corporate structures or specialized investment accounts. Why does this matter for someone starting at 52? Because you do not have 30 years to let the magic of compound interest fight off the taxes. Every basis point of efficiency now carries 10 times more weight than it does for a 20-year-old. Investing through a tax-efficient structure gives you an immediate 20% yield bonus. You did not earn this money on the market. You simply did not let the system take it. This is the purest arbitrage that exists. Your dividend plan starts not with picking Coca-Cola shares, but with picking the jurisdiction and account type. If you ignore this step, you just gifted the state 5 years of your future retirement. Typical advice for 50-year-olds is to be conservative and buy bonds. Let us analyze this through the lens of behavioral economics and inflation derivatives. Bonds today give 4 to 5%. Real inflation, not the one in the news, is around 6%. Your real yield is minus 1%. A conservative strategy at 52 is a guaranteed way to die poor, but stable. We need the barbell strategy. This is Nassim Taleb's concept, adapted for life forensic auditing. 85% of your capital goes into maximum protection and liquidity, such as cash equivalents and treasury bills. This is your shield against sequence of returns risk, the risk that the market crashes the exact year you decide to retire. But the remaining 15% we direct into instruments with high positive asymmetry. This is not a lottery. This is the volatility selling I mentioned, or concentrated positions in scarcity sectors like energy or military tech. The goal of this 15% is to give you an explosive return of 500 to 700%, which will cover the stagnation of the main portfolio. If you are wrong in that 15%, you still have your core capital. If you are right, you cut your path to the finish line by 7 years. This is pure game theory, capped downside, infinite upside. Why is Kyle at 52 a better investor than Kyle at 22? Because he does not have a dopamine addiction to charts, he has what we in the Big Four call operational discipline. At 22, you invest to buy a Lamborghini, but at 52, you invest to buy your time. Your psychological advantage is the lack of need for daily moonshots, as you now focus on sustained yield. But there is a trap that psychologists call loss aversion, the fear of loss, where you are so afraid of losing what you have accumulated that you paralyze your capital. Remember that cash under the mattress is an asset with a yield of minus 6% per year. You are losing money every single second until you finally make a decision. At 52, your main enemy is not market volatility, but the time you spend studying the issue. The efficiency coefficient of your life now depends on the speed of transition from consumer status to capital architect. Forget about receiving a 3% return from Johnson & Johnson. If you are 52 and have 0, 3% is mathematical noise. You need a cash flow of 12 to 15% per year to form capital in time. How do we do this without turning into a gambler? Through synthetic dividends. In investment banking, we do not wait for the mercy of the board of directors. We create our own profit by selling insurance to those who want to play in the casino. This is the covered calls and cash secured put strategy. You want to buy shares of a quality company, but instead of just clicking buy, you sell a put option. The market pays you a premium for your obligation to buy these shares cheaper than they are right now. If the stock does not drop, you simply keep the premium, and that becomes your dividend number 1. If the stock drops, you buy it at a price you liked anyway. You effectively receive the shares with a discount equal to the premium you were paid. Once you own the shares, we sell a call option. You get a premium for the obligation to sell the shares if they rise significantly. That premium is your dividend number 2. By using the time decay of the option, known as His Majesty Theta, we generate a stable 1 to 2% yield every month. That is 12 to 24% a year. This is a derivative on volatility, where we capture profit from the constant and unpredictable movement of the market. While the gurus hope for stock growth, you earn on the fact that gamblers exist. This is the true investment forensic. We become the casino, rather than the player at the table. At 52, you have no right to a 20% error in portfolio drawdown. Gurus say buy tech because it is the future, but forensic audit shows tech companies often have negative free cash flow and 0 dividends. These companies do not operate on real value. Instead, they live on cheap credit that can vanish in an instant. We build the portfolio on the economics of scarcity, prioritizing assets that are becoming harder and harder to find. When you have 13 years left, you must own what people cannot stop buying, even if the world is falling apart. Number 1 is energy, including old oil and nuclear. The world simply will not switch to solar panels in 10 years. The shortage of oil and uranium is a mathematical certainty that we can calculate with clinical precision. Number 2 is the defense sector, where geopolitical volatility becomes your asset. Rearmament budgets are growing by 20% every year, representing a state-guaranteed cash flow. Number 3 is infrastructure, including water, electricity, and ports. These are assets with a deep moat, where prices are naturally indexed to inflation. If a company cannot raise its prices by 10% in a single day without losing its customers, then we do not need that asset. This is our essential safety filter. Why does Kyle have 0 at 52? Because he fell victim to the endowment effect and the heavy weight of social pressure. He bought a house that is far too big for him, and a car that loses 15% of its value the very second he leaves the dealership. In Big Four accounting, the house you live in is a liability. It does not bring in money, it consumes it. Taxes, repairs, and insurance. This is your negative dividend of 3 to 4% of the house's value every single year. For the dividend plan at 52 to work, you must perform a hard liquidation of inefficient assets. If your house is worth $1 million and you live in it alone, you just froze $1 million in capital with a yield of -4%. Selling that house and investing the freed $700,000 at 10% per year is an immediate change in your net worth of $70,000 a year. Here is your step-by-step plan. Year 1. A complete stop to excess consumption. We liquidate all loans with an interest rate above 5%. This is priority number 1. Year 2. Building a liquidity cushion equal to annual expenses. We keep it in money market funds at the risk-free rate. Year 3. Market entry through selling put options. We do not buy assets at market. We wait for the market to pay us to enter. By the end of the 3rd year, your capital should start generating its first stable flow. If you did everything right, your synthetic yield should already cover 20 to 30% of your basic needs. The engine has started. Most investors relax at this stage, but you must recognize that this is a dangerous trap. At 55, your main risk shifts from market movement to the silent killers of tax drag and management fees. If you use active funds that take 2% for management, in 10 years, they will take 33% of your potential capital. This is mathematical robbery, so during the acceleration phase, we switch to low-cost instruments and maximum tax deferral. Calculating the growth derivative. If Kyle invests $3,000 a month at 12% per year in a tax-protected structure, in 10 years, his capital will be around $720,000. But if he pays income tax every year and a management fee, he will have only $480,000 left. The $240,000 difference is the price of your laziness. At this stage, we become optimization fanatics. Years 10 to 13. Kyle is 62. His portfolio is approaching $1 million. Now the boss of the financial game appears, known as sequence of returns risk. If the market drops 30% in your first year of retirement, your plan collapses. To prevent this, 3 years before our X, we build what we call a cash bucket. We move expenses for the next 3 years into short-term bonds and cash, so if the market crashes, Kyle calmly lives off the bucket without selling assets at the bottom. This is game theory against market chaos, and now let us do the final forensic audit of Kyle, who started at 52 with 0. 13 years of discipline, liability liquidation, tax arbitrage, and synthetic dividends led to this. A total capital of $1,200,000. With a net yield of 7% per year, he now receives a monthly check of $7,000. This is 800% more than the state pension. But the main thing is not the numbers. It is the derivative of freedom, as Kyle no longer depends on the labor market and has become a sovereign institution. You ask, where is the happiness? And I answer that happiness in this scenario is the absence of fear of a bank statement. It is the ability to say no to any system that tries to exploit you, and I have just given you the manual for your last chance. Mathematics has no emotions, it only has results. I am Kyle, and this was your forensic audit.